Here we go. Thanks everybody for joining us. We know it's a little bit short notice for our special market volatility update, but we appreciate the staff getting this together for us. And we'll have a quick talk here, but we'll give it a minute or so for the rest of the folks to log in. And just a little bit of housekeeping while we have it. We are recording the meeting for folks that couldn't make us, so they could see it tomorrow or this afternoon. If you want to share that, that'd be great. If you have any questions for us, you can post them in the chat below. Yeah, if anything other than that, we'll get started here in a minute or so. So, yep. I think that's about all we have registered. You want to be good?
Yeah, we'll get started.
All right, cool. So welcome everybody to our special market volatility update. Josh and I are excited to come to you here. Melissa joined us here behind us, but she helped us put this all together. Let's talk about. Oh, where's she at? Right here. There's Melissa. All right. Here's what we're going to go over today. So what's going on? What have we seen recently? What does it mean for you? What are we doing here at Stein Wealth Advisors? And what can you be doing over the next month or so to, be proactive with what we've seen going on? So Josh, there's been a lot of news over the past few weeks, and we've seen some volatility, although recently the market's kind of pushed back up. What do you think the major things we saw recently that we should be concerned or take attention to? And then maybe what does that all mean? So what are some things that you've seen recently?
Sure. Well, first, thanks everybody for joining us today. And I'd like to spend most of the time talking about one particular thing. And there's been a handful of different events that have caused market fluctuations, although like you said, despite some of the volatility, it's actually been pretty stable overall with some down days, but some up days to kind of recover. That being said, there's one word in particular that I think has caught on more than anything else, and we've gotten probably more questions about as of late, which is inflation. So I'd like to spend a little bit more of this discussion in particular kind of talking about inflation and what that means, what the impacts are, some of the things we're doing about it, some of the things you as clients may be concerned about, or what you can do to improve your situation. But the interesting thing about inflation is it's really been a subject that hasn't gotten much news at all for a really long time. If we rewind back to the beginning of the Great Recession back in 08, 09, after that period, we've really seen historically low inflation rates, 2% or less. And that's due to probably a handful of factors, but in particular, having low inflation during that period of time has really caused most people to almost not really think about the impacts of inflation and what that means, or at least I should say the impacts of high inflation with regards to how we've seen it over the last 20 years or so.
I think that's well taken. And maybe let's hit pause real quick. So for anybody that may be listening at home, real quick, what is inflation? And let's talk about that and why is that important, especially when we're doing comprehensive financial planning.
Sure. Well, I think everybody pretty much knows that inflation means things cost more, but I think what would be more important is to kind of talk about why and kind of the root to that, and that will also help really set up the landscape for why what has happened since COVID has really caused the perfect recipe for potential inflationary concerns. Although I'll preface by saying they're potential because it's a lot more detailed than that. But let's talk about that. So I always describe inflation in its simplistic form as too many people chasing too few goods. So at the end of the day, inflation in terms of pure just economics, or in terms of like textbook economics, would be high demand, low supply. When demand goes up and supply goes down, you see inflation increase. So rising costs, or let me say costs push inflation higher and demand pull inflation higher. So your costs would go up when just your cost of goods in general increase. We've seen this. This is one that probably people are more familiar with. We see this with regards to like oil and gas, raw materials. Just when the price of raw materials go up, then of course the good that it produces would likely go up. Rising costs are increased due to wage increases. So as the money supply increases due to people getting more money in their paychecks, that would cause costs to go up, or a weaker currency. So when your currency becomes devalued, we'll talk about that in a little bit as well, that can cause prices to go up. On the flip side, what impacts demand? When you have solid economic growth, when people are feeling more confident about spending, demand increases. And I think that's certainly one that we've seen post-COVID. Even though we had a very volatile 2020, we've been riding on one of the largest economic expansions ever. And certainly that bodes well for solid economic growth. Higher inflation expectations just in general. So the general sentiment is that inflation will increase. People are going to go out and they're going to spend their dollars today to kind of lock in that price. And I think we're definitely seeing that now, although that's new and that really hasn't been the case for many, many years. Certainly, I think inflation expectations are causing kind of an effect of it's happening because people are expecting it.
Yeah.
Tax cuts, that's one way to increase demand, although we're not necessarily seeing that in the potential new Biden administration. Likely we'll see tax increases. One could say that we are in general in a low tax environment regardless. In particular right now, and even potentially after any Biden tax changes, and that's really a subject for a whole nother discussion, but that's one thing. And then excess or discretionary government spending is one, whether intentional or unintentional. And absolutely one of the big factors playing today is just how much money the government has spent through the pandemic, through stimulus and all the benefits that they've provided, certainly has caused demand to increase. So you got this kind of equilibrium between supply and demand, and when your supply decreases and or your demand increases faster than your supply can handle that, you see inflation.
And it seems like we're seeing a lot of different things from, unique jobs reports, unique CPI numbers, a little bit of market volatility, but it all to us seems like it waters down into this inflation question, because that's the most tangible for our clients and the factor that will affect them the most. So I think we want to go into CPI a little bit more. And I think you had done some research from 1976 to now between rising inflation and an economic expansion, because from what our consensus is, we are in an economic expansion period right now. However, that doesn't mean we are not going to be subjected to periods of potential volatility and these other factors like inflation and others. So you had some stats I think you wanted to share with us on that, where if we're in a rising inflationary environment and in an economic expansion period, is that a bad thing? Is that a good thing? And what can we take from that?
That's a good question. That's probably the hardest question to answer too. So, I think the first response or the first question that people have to us about inflation is inflation bad? What will happen to the stock market in particular if we see higher inflation? And that's a really hard question to answer, not because we can't, but because inflation and stock market performance in particular are not directly correlated. In fact, inflation and many other economic issues or factors are not directly correlated either, meaning inflation on its own isn't really necessarily a good or a bad thing. It's just a thing. And really what is important is all of the other components within the economy. So inflation is kind of like a singular component within a multidimensional economy. And there isn't a direct result. Like if inflation goes up, this happens. What the answer is if inflation goes up and then B, C, and D happen, then we can get an idea of what historically things have looked like. But we really have to then more identify what the other variables we are going to assume happen are. And for example, to answer what you have brought up, inflation and economic expansions or contractions become very important. So for example, if we look back to 1976 and we identify the periods of time that we've either had economic expansions or economic contractions or recession, and then we look at how inflation came into play, we can get some better data. So the short story to this is really, as long as the economy tends to essentially continue to grow or have periods of economic expansion, inflation really is somewhat of a moot point to the stock market. It may impact other things, obviously, it may impact the price of goods and spending and things like that, but just pure stock market, it's really not a bad thing. In fact, the average rate of return during high inflation or rising inflation environments during an economic expansion is double digits. We've seen really good stock market returns. It's when the stock market is negatively impacted by inflation is when we are in an economic contraction. So when you have a recession on top of high inflation, that's generally not good for the stock market.
And we were discussing a little bit about some of these outlying factors. So let's say Chairman Powell decided that he and the committee thought that the market or the economy was expanding too quickly, and they wanted to curtail that with some of their tools in their toolkit. That could spark off a recession in an inflationary period or something to that. So it's something for us to keep an eye on, but it's not of overt concern right now. And I think we were also discussing CPI is a telling factor, but just like when we run a financial plan, we can run a financial plan with a static rate of return, but that doesn't take into consideration variance, which is much more important than a static linear calculation, which gives a baseline like a CPI. So I think when we look at CPI and we see these reports of consumer price index is increasing, inflation is up, taking cognizant value of that in its right capacity. So, when we look at our plans and maybe talking a bit about what we're doing here at the firm, we're constantly looking at what that inflation number needs to be as we build our plans out to be reflective of what your actual cost is going to be, because that's what our clients primarily care about is what are things going to cost for me when it's that time.
Yep, absolutely. And CPI can be a little misleading, no question. The consumer price index, CPI, is really good at showing pricing over time, but it's not really good at identifying what else is happening within the economy. So it's kind of very like, it gives you a good idea relative in time, but not really like what else is going on. And like I mentioned before, the real answer to is inflation good or bad is everything else. And so when you look at the CPI in particular, like let's take a look at what's going on now. The last report that came out from last April, the CPI index was up about 4.2% on the consumer side, and on the producer side, it was up about 6.2%. And that was high. The expectations were running around 3 for the consumer side and about 4.6 for the producer side. So certainly higher. But what does that mean? Well, we're also comparing that to a point in time where we were kind of at the very peak of the COVID issues. And so we're comparing that to a time where they were maybe even artificially low. So yeah, I mean, is it a concern that they're up? Yes, but also the CPI really just kind of shows 2 points in time. And so it's not really the full picture. And I think that's where Chairman Powell, who has really kind of been the front runner in speaking to the news media and giving opinions about their ideas about where inflation is going. They've been pretty lenient to see higher inflation right now. The word that he keeps using is transitory. So, and that's the big question, is what we're seeing now with higher inflation, because likely from our research, the expectation is in the short term, at least through the duration of 2021, we could see some pretty scary inflation numbers. I mean, we could see it run pretty hot, even hotter than it is now. The question is why? Is it going to run hot for this period of time? Because remember that supply demand issue. So demand's up and supply chains are down. And, you know, we were talking about this earlier. We all kind of always talk about the economy as we shut off the economy when COVID hit, and you know, we kind of went into a shutdown. And then we turned on the economy when things got better, right? But the economy is not a light switch. Like, it doesn't just shut on and off. So
We
when
still had to come to work during COVID, right? Melissa made us come to work.
she did,
Absolutely. So the economy didn't shut down.
Yeah,
It just
right,
toned
the
down a
economy
little bit.
doesn't just turn off. So when we turn back on the economy, we turn the light switch back on, things had happened. Businesses had gone out of business and not returned.
Right.
People had lost their jobs. People had changed jobs. People had changed what they were producing, and supply chains. I mean, I know we've heard it a million times on the news, but supply chains were impacted by that. So just because we all decided that the economy was back up and running doesn't necessarily mean that the supply output side of things was ready to handle the pent-up demand. And so not only did you see this strange thing where supply chains were disrupted, not just because of the time that they were off, but because a lot of them didn't even come back.
Mhm.
But now you also have all these people stuck in their house for a year who now all of a sudden want to go spend money. And whose money are they spending? They're spending the government's money. And we saw the largest increase in the M2 money supply, which is the measure of how much money is actually like in the economy being able to be spent, meaning not locked up in bank reserves. We saw the largest increase ever historically. And so more people had more money to spend and were more ready to spend money than ever before. And guess what? Now all of a sudden, the goods aren't able to be produced because of the breakdown in supply chains. I mean, it's no question we've seen a spike in inflation.
Well, and if you want a great example of this, Melissa did a wonderful video with Jackie yesterday, one of our real estate professionals. And if you want to, and you can expand this to many of the varying sectors in the market, but just look at real estate alone. We've seen a unique situation with the supply of materials, the supply of homes, and the interest rates pushing all of these unique factors into that scenario. And you see crazy home appreciation that we haven't seen probably since 2007. So, I mean, that is something to be taken into consideration. Absolutely. And there's lots of other examples of that. But if you missed that video, check it out. It's posted up on our website.
So the Fed's perspective is that this increase in inflation that we've seen right now is more temporary, more due to a breakdown in supply chain and an increase in demand. But from their perspective, at least their outlook is that should somewhat slow down and recover as the supply chains continue to kind of get back. The question is, will that happen? And will people essentially go back to their normal spending habits? And the interesting kind of component to this is, we talked about a moment ago how an increase in government spending has historically led to higher demand, but does that lead to more inflation in reality? And if we go back in time and we look through 08, when I talked about before, when we had this massive QE spending at that time, we didn't really see high inflation. And so Powell has kind of been challenging the kind of the standard economics of more money doesn't necessarily mean higher inflation.
Which is a big contrarian, right?
That's a huge contrarian.
Right. Most Fed chairs are very by the book in that interpretation of that.
That's economics.
Right. That's like baseline economics. And for a Fed chair to be like, hey, maybe we need to consider this, that's something that we are considering.
No question. In fact, he even came out publicly and said we need to unlearn the idea that money growth causes inflation. Mm-hmm. That's really tough to say whether he's right or not.
Right.
I think time will tell, and he'll either be a genius or we could see some serious inflation that potentially the Fed was not expecting or underplayed. We won't necessarily know that until it happens, though, because hindsight will tell us that.
So I think that's a great distillation of a lot of news that's happened over the past month, a lot of movement in the market that we hadn't seen with that big expansion at the tail end of last year. Let's talk about what we're doing here, and then we'll transition to what our clients can be doing at home to take advantage of this scenario, right? Because that's our goal, is to take good advantage of every scenario that's laid in front of us. This is unique, like every scenario we get, but there's some good stuff here. So we've recently been going through a portfolio rebalance. We picked up some positions we feel are going to bolster our inflation protection in those. I believe in our growth allocation, we positioned out there, and folks are in that. And let me see, with our plans, we made some adjustments as well. So you want to talk to that? I mean,
Well, yeah,
every plan's different. Every client's portfolio is unique, but we
right.
made adjustments in our models to reflect some of these situations, as well as make sure that we're taking tangible effect in the plans, because that's
Well, yeah, I mean,
through it.
that's probably, I think, actually the more important piece. And I know in particular, you as clients out there, you'd love to hear us say, we've rebalanced everybody's portfolios to include investments that are completely immune to inflation. And that's where things get challenging, but also at the same time, that's where things are actually somewhat more realistic, because like I mentioned at the very beginning, higher inflation doesn't necessarily mean for stock market returns. So it's not so simple as to just reallocate to investments that are immune to inflation, because A, it may not even be necessary, and B, it doesn't really work that way. And I always kind of like to remind people that investments in particular are very different than the goods that make up this consumer price index. You're not spending your 401k. You're not spending your investments in your IRA. Those are assets, and they work differently than tangible goods that you can kind of assign these points in time to look at, did inflation impact them? And really, for all intents and purposes, it's not as clear of a line saying you will have an investment that is immune to inflation or will be hurt by inflation, because they're not really correlated. That being said, there are specific things we are trying to monitor and tactically allocate the portfolios to the other economic impacts that we may see, regardless of kind of what inflation does. The money, the U.S. dollar index, I think, is an important thing that we've been constantly watching. I mentioned before about how weaker currencies can lead to rising costs. And what's been very interesting to me is when you go back and you look at the US dollar index, although it's off its peak, it really hasn't changed that much. And we've seen the strength of the dollar despite some of this inflationary concerns and despite some pockets of extremely high inflation right now, stay relatively strong. So the average of the US dollar index going back 10 years is about 90. Okay, and we're hovering right around there right now. And I think within the last 5 years, it's been about 95. And so we're probably off a little bit off the average, below the average for the 5-year rolling, but 10-year rolling, we're still pretty much around an average. Now, the US dollar index peaked at a little over 100. So, we're 10 points below the peak, and that could show maybe some potential weakening of the dollar, but on average, it doesn't really look like we've lost too much in terms of the dollar strength or weakness. And one thing I do like to always remind myself in particular is, despite people's opinions about the United States, the rest of the world would rather own the US dollar than their own currencies. I shouldn't say the rest of the world, but much of the world would rather own the US dollar rather than their own currencies. And they're happy to take our problems, and they're happy to take the issues of the US economy, given the fact that for all intents and purposes, we're more stable than their countries. And even despite our low interest rates, given the risk return of our low interest rates, they're even more favorable. So it takes a lot to really push down the demand, or I should say the value of the US dollar, I think significantly, just because you're going to see international investors gobble it up as it goes down to bring it back up, because even a weak US dollar is stronger than their dollar in particular. And we're in such a global economy now that that plays a big role, and that's actually a really good thing to the stability and the how resilient the US economy is, and the US dollar benefits from that. What asset classes tend to do better or worse in rising rate environments or rising inflationary environments? Growth does win over value. So like growth stocks, like your FANG stocks or tech, tend to do better than like high dividend paying stocks or blue chips or your large values. And as you mentioned, we've had a slight overweight towards growth over value. But mean, we're not talking anything significant, but slight overweights in certain growth areas. And equities in general tend to outperform fixed income. Really, and you and I did a whole webinar, which is probably still online, a few months ago, about kind of the relationship between rising inflation, rising interest rates, bond prices, all of that. But to boil it down to the Cliff's Notes version, as rates go up, bond prices go down. And so if we can assume that as inflation increases, the Fed starts to raise rates, that pushes the price of bonds down, and we're actually underweight in our fixed income for that reason in particular. So, does that mean that bonds are going to be down? It's hard to say, but other asset classes may look more appealing relative to their overall risk, and we've made some of those adjustments. We haven't. I mean, we didn't just do it now. We've been doing this. We always do this.
That's our job.
Yeah, I mean, there's always new events, but the events never go away. People ask us, sometimes, Josh, what do you feel about volatility in the stock market? Well, we're always worried about. I mean, worried is a bad word. We're always looking at that. So there's never a time that you, me, Melissa kick our feet back up on the desk and we're like, we got 6 months of headwind here that we could just, invest.
We started our careers in 2008. We're just perpetually ready for bad markets.
Well, it's not even good or bad markets. It's just, we never approach this as like, this is a time where we're never going to have any challenges.
Absolutely.
There's always a challenge. The challenge right now, in my mind, is very clear. We have to monitor inflation. There's no question. And we have to somewhat identify what the impacts could be if we see rising inflation. The truth is the Fed's going to make a lot of those decisions for us. And we live in an economy where the Federal Reserve has such a strong power over not only the economy, but indirectly the stock market, obviously interest rates and everything in between. I mean, they intentionally manipulate, and I don't necessarily mean manipulate in a bad way, but they manipulate what happens to the economy, to the stock market, to interest rates.
Tune it up, cool it down, etc.
That's their job.
Yeah.
And I think right now Powell is really facing a significant role in the outcome, some of which he may be able to control with good monetary policy, some of which is going to be difficult to know the outcome until it's too late. But that doesn't necessarily mean it's it's a bad thing. It just means that that's the key issue right now. And we're always certainly doing our best to try to see the forest through the trees, figure out what's just noise and what's real, and how do we keep our clients safe from some of these external factors that may or may not even be important.
So well said. And that being said, let's transition to what can we proactively do. So we're watching the portfolios, we're keeping an eye on the variables and how it affects real things. But the key thing I wanted to close with today was, what can our clients be doing maybe this summer as things open back up to get themselves in the best position possible? So either they come in for the review meeting, or if something does happen that we need to make adjustments, like what can they be doing to make sure that they're in the best position to take advantage of this, or make adjustments if necessary if we do see something get concerning, which it hasn't yet, but if it did.
Yeah, I mean, that's a good question. I don't think anything different than ever. I think the biggest concern that people have about inflation is first, like, is the stock market going to collapse? And like we already identified, that's not a direct correlation. Will the stock market have volatility? Of course.
That's to be expected.
And I think the worst outcome we'll see is the Fed raise rates too fast because inflation is too hot, and we potentially spin off into a contraction, and then we could be facing a recession. Certainly that has an impact on the stock market. But again, that's nothing individuals can control. In fact, quite frankly, that's nothing we can control. But what we as advisors can control is the volatility within the portfolio. But obviously we can't control if the markets go down, but that's okay because we're not trying to time the markets. So what else can people do? I mean, from a financial planning perspective, your long-term goals and objectives, and in particular your spending,
right.
So certainly if you're gonna be buying lots of goods that could potentially be more expensive than you had planned on, maybe that should be identified,
right.
and talked about with us. We should and continue to revisit our models for inflation that we use when we plan and project out decades in the past. And we have our assumptions set in our planning softwares, and we're kind of regularly looking at whether or not those assumptions are accurate. And I think just good communication between what your spending needs are, if they've changed because of any goods that potentially have gone up that need to be purchased in our planning scenarios. As long as they match, I really don't think that there's much with regards to inflation that anybody needs to do. But if they don't anymore, then yeah, we absolutely should have a conversation about that.
So keep an eye on our budget. Everybody has a new budget right after COVID. Everything was kind of crazy last year. We're all getting a new budget and we're adjusting to that. Take a look and see if it's changed and see if it's increased or decreased or what have you. So when you come to us, you have the best data available, and we can help you make great decisions around that. The other thing I think that is a wonderful point is if you do have some larger than average purchases on the horizon, get tactical about them. Make sure that you're researching those prices. Do I need this right now? Or if that might be something is it temporarily inflated or is it permanently inflated? Right? If I'm building a house right now, there's consideration to those costs, and it could be substantially higher or lower.
Sure.
And that falls through to any other purchase that you may be making. But we're here for you when that happens, and we want to be supportive in that role. But the better data that we get coming in, the better that we can support you in that. But I think that's proactive things that we can all do. And I think everybody's budget changed last year a little bit in some way, shape, or form. So
maybe the only other thing I'd say, and I know it maybe sounds a little bit silly, is we're going to be hearing on the news in particular about inflation for a long time.
Right.
And just remember that it's in the news's best interest to make inflation be all doom and gloom and imminent, because that keeps you tuned in. And so just keep that in mind. And it doesn't mean that it's not something that should be taken seriously. It certainly should. But there's a lot more to the story. And I think it's more important for you to focus on your goals and objectives. And if those have changed, and with our partnership, with how we help you with your planning, and then certainly of course the investments, we should be able to figure out a reasonable approach that keeps your success of your planning on track.
Cool. Well, let's open it up to questions. I'm sure we might have a couple of questions here in the chat. I want to make sure I looked at it right. Nothing yet, but if you have anything, make sure to drop it in there. But while we're waiting for any questions, we've had everybody for about 30 minutes, and we certainly appreciate your time. Thank you for joining us today, and we appreciate sharing this with anybody you feel would find interest in it. Let me see, Josh. I think we covered everything we wanted to cover.
Any questions?
Any questions, guys? Great. All right. Well, if you have any additional questions, Josh, where can I find more information about Stein Wealth? Like, where would I go to? Steinwealth.com?
I think that's it.
That's the place. And if I have a question, info@steinwealth.com. I think that's the best place to.
Sure. Or just give us a call.
Or just give us a call. So everybody, thank you for joining us. We very much appreciate your time today. If you have an idea for a video or a piece of content from us, let us know. We're trying to provide you with everything we can to keep you engaged with your financial plan. And we appreciate your time. Yeah, Josh and I enjoy doing this. And if you need anything else, reach out. We're always here for you.
Thank you, everybody.
Have a nice day.